Hey everyone, welcome back to Corporate Decoder, the place where we uncover the hidden stories behind your favorite company's latest financial filings. And today we are diving deep into OI Glass, Incorporated's annual report, their 10K filing for December 2025. And let me tell you, there is a lot to unpack, especially when it comes to their profitability challenges and bold strategic moves. So grab your popcorn because this is going to be a ride. We'll be looking at their financial performance, their risk factors, their ongoing strategies, and what it all means for the future of this global glass container. Giant, first off, before we get into the nitty-gritty, if you love getting these straightforward, unbiased insights from complex corporate documents, make sure you hit that subscribe button. Also, we have a thriving community over on Discord, linked in the description below, where we break down these filings even further and share investment ideas. It is the perfect place to level up your financial literacy. Alright, so what is this document all about? It's OI Glass Incorporated's annual report, their big yearly update for us investors and regulators. The 10K filed with the CC, they are a well-known seasoned issuer, meaning large established public company with their common stock traded on the New York Stock Exchange. Under the ticker symbol OI, iGlass isn't new to this. They've been around since 1903 and are one of the top glass container manufacturers globally with 64 plants in 18 countries. They're the big player in most of the places they operate. Now, the big story here is something they call the Fit to Win initiative. It sounds like a corporate comeback plan started in 2024. This program is all about cutting spare production capacity, making their factory network more efficient, and generally trimming costs like those selling and administrative expenses. They expect this to take at least until 2026, and they are not playing around. They've already announced factory closures and job cuts. They believe this will ultimately boost shareholder returns. Their new vision is to make the power of glass accessible to everyone every day, and they have a 3-horizon roadmap to get there. Horizon 1 is this Fit to Win initiative, focused on immediate cost cutting and improving competitiveness. Horizon 2 is about profitable growth, where they leverage their new cost advantage to win over customers and compete with alternatives. It's like aluminum cans. Horizon 3 is more about future growth options, like expanding geographically or through mergers and acquisitions. They break down their business into 2 main parts, Americas and Europe. This is how they manage and evaluate their global glass operations. Their biggest clients are major global food and beverage makers like Anheuser-Busch, InBev, Coca-Cola, and Nestle. They even mentioned one major customer that accounted for about 10% of all their sales in 2025. Energy costs are a big deal for glass makers, accounting for 10 to 20% of manufacturing costs, while they have contracts that pass some energy price increases to customers. Not all of them are fully protected, especially in Europe, where energy contracts are resetting at higher cost levels. This definitely adds a layer of risk. In 2025, they made a significant strategic shift. They decided to stop investing in something called the Magma program, which was about new furnace technologies. Apparently, it didn't meet their financial goals, so they recorded about $104 million in charges. For this decision, they will still roll out their Ultra technology, which makes bottles lighter, but future R&D spending will be much lower. Sustainability appears to be a major focus for Odin iGlass. They are setting targets for using recycled glass, reducing energy and CO emissions, and increasing renewable energy use. They are guided by UN Sustainable Development Goals and have an ESG oversight committee. Recycling is key. They use a lot of recycled glass because it cuts emissions and energy costs. However, new laws around recycling extended producer responsibility, and deposit return systems are popping up globally. This could impact their business and the availability of recycled glass. Governments worldwide are pushing for stricter climate regulations, and iGlass is aware of this, especially with the EU Emissions Trading Scheme, or UETS. They have to buy emissions allowances, and free allocations are phasing out, which could increase costs. They are also monitoring greenhouse gas emissions regulations in the Americas and are taking steps to improve their environmental profile. Safety is a top priority. They have robust programs to identify hazards and track incidents, and they are unable to predict future workplace safety legal requirements, but they are investing in improving safety. They have about 19,000 employees worldwide. Their operating principles focus on safety, transparency, productivity, sustainability, and value creation. They are committed to a diverse, inclusive, and respectful work environment. Looking at the leadership team, Gordon J. Hardy is their Chief Executive Officer since May 2024, and it seems like there have been several other executive shifts in the past couple of years to strengthen the management team. Now, for the risk factors, this is where they tell us what could go wrong. Global profitability improvement initiatives. Their Fit to Win initiative could have a material adverse effect if they fail to achieve expected benefits, and the charges and outflows associated with it could be significant energy costs or availability interrupted power supplies and higher energy costs. especially with the ongoing geopolitical conflicts, can seriously impact their operations competition. They face intense competition not only from other glass container producers, but also from alternative packaging like aluminum cans and plastic containers. This can squeeze their profits. Changes in consumer preferences or customer inventory management can hurt their sales. They note that since 2023, they have seen elevated inventory destocking, especially with wine, spirits, and beer customers, which negatively impacted their shipments. They are exploring AI, but acknowledge the risks. This includes intellectual property data privacy, ethical concerns, and the potential for inaccurate or biased AI systems. If competitors are more successful with AI, it could hurt their competitiveness. Their decision to halt the Magma program means future spending on R&D will decline if they cannot improve their melting technology cost. Effectively, they might struggle to stay competitive, especially with the push for lower carbon processes. Global supply chain issues are affecting their capital expenditure plans, affecting their ability to get equipment and materials on time and within budget. Unexpected breakdowns in their manufacturing assets are a risk, and these can lead to higher costs, and lower absorption of fixed cost insurance might not cover all liabilities. The cost and availability of sand, soda, ash, limestone, and recycled glass are key. The primary raw materials have historically been available, but temporary shortages or price volatility remain a concern. Strikes, disruptions, or shortages in the transportation industry could increase their costs and disrupt their ability to serve customers on time. Many employees are unionized or represented by workers' councils. Negotiating new contracts can be tough, and strikes could increase costs. Labor shortages could also lead to higher compensation expenses. Goodwill represents about 16% of their total assets, and they had a significant write-down of goodwill in 2023. This highlights the volatility in their business valuations, and future impairments could materially impact their results. Looking at the financials, their balance sheet shows total assets of over $9.2 billion for 2025. Current assets include over $2.6 billion, with inventories making up a significant chunk. Just over $1 billion, in fact. Other assets are also substantial at over $3.1 billion, with goodwill alone being almost $1.5 billion. On the liability side, accounts payable were over $1.2 billion. They also have a significant amount of long-term debt standing at around $4.8 billion. Now let's talk cash flow and profitability. Operating activities provided $600 million in cash for 2025, up from $489 million in 2024. This increase was mainly due to higher non-cash charges and lower working capital levels, which is good news. They used $128 million for restructuring payments in 2025, which is higher than the previous year due to the Fit to Win initiative. Net sales in the Americas went up slightly to $3.6 billion in 2025, driven by higher selling prices, which helped overcome lower shipment volumes. However, unfavorable foreign currency exchange rates did impact this segment. Europe saw a decrease in net sales to $2.7 billion in 2025. This was mainly due to lower average selling prices and weaker shipment volumes. Competitive pressures and a major project startup were cited as reasons. Favorable foreign currency exchange rates did provide some boost. Segment operating profit in the Americas jumped by a solid 40% to $549 million in 2025. This was largely due to cost savings from the Fit to Win initiatives and some favorable discrete items like insurance settlements. Europe's segment operating profit dropped by 17% to $297 million in 2025. Higher competitive pressures, coupled with lower net selling prices and weaker volumes, were the culprits. However, Fit to Win initiatives did contribute positive cost savings here too. Then we see the significant restructuring, asset impairment, and other charges totaling about $443 million in 2025. This is largely tied to the Fit to Win initiative and includes employee costs and write-downs of assets. They expect another $50 million in charges in 2026. Looking at the balance sheet again, we see total assets of over $9.2 billion in 2025. Current liabilities are over $2 billion, with accounts payable being a big chunk at over $1.2 billion. Long-term debt is significant at $4.8 billion. One fascinating detail is the valuation allowance on their deferred tax assets. It is a massive $647 million for 2025. This means they believe it is unlikely they will realize a significant portion of these deferred tax assets, indicating potential past or ongoing profitability challenges in certain areas. Their total long-term debt is substantial at nearly $4.9 billion at the end of 2025. They recently refinanced their credit agreement, which provides them with significant borrowing capacity. However, they face restrictions from this agreement and others which could limit their flexibility. They have non-controlling interests, meaning parts of their business are owned by others. This is reflected on their balance sheet and in their net earnings calculations. Depreciation and amortization are significant expenses around $391 million in 2025 as expected for an asset-intensive business. The bottom line for 2025 shows a net loss attributable to the company of $129 million, which is worse than the $106 million loss in 2024. Their overall comprehensive income, however, turned positive in 25 thanks to favorable foreign currency translation adjustments and changes in derivative fair values. The auditors highlighted goodwill impairment assessments as a critical audit matter, particularly for their Europe reporting unit. This means those numbers involved complex judgments and assumptions. This is a key area to watch for any future changes in reported value. So what is my take on O? Eyeglass Incorporated, well, they are in a tough but essential industry. The Fit to Win initiative shows a clear focus on improving efficiency and cutting costs, which is absolutely necessary given the competitive landscape and economic pressures. However, the significant restructuring charges and the massive valuation allowance on deferred tax assets point to underlying profitability challenges and perhaps a difficult operating history in some segments. The risks related to energy cost, currency fluctuations, and ongoing competition are very real, and their reliance on AI is a double-edged sword offering potential benefits, but also introducing new uncertainties. Their debt load is also considerable, but their refinanced credit facility provides a cushion. The company's direction seems to be towards leaner operations and strategic growth, but it is a delicate balancing act between investing in future tech like Ultra and managing the legacy issues and current market headwinds. They have strong brand recognition and relationships with major clients, which are significant strengths, but they need to consistently translate their strategic plans into sustainable financial results. What do you all think about O? Eyeglass's latest report, are you optimistic about their Fit to Win strategy or concerned about the risks they face? Let me know your thoughts in the comments below. If you found this deep dive valuable, give this video a thumbs up and subscribe for more of these corporate decoder sessions. And hey, don't forget to join our Discord community, linked in the description below for even more detailed discussions and insights. Thanks for watching, and I'll see you in the next one.